Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, we have Russell Rhoads, Head of Research at EQ Derivatives, to discuss why traders should be watching VOLQ versus VIX and what it could indicate for an economic recovery. But before we get into the vol part of the equation, Russell, tell me why you're watching the Nasdaq 100 so closely.
Well, everybody is watching all the different market indicators very closely right now. And thank goodness I'm not one of those people that has to make a 2023 prediction. But I think the best thing that you can do is watch what you think the Fed's going to do, but then also watch what industries, stocks start to perform well when we're in some sort of a recovery. And many of the technology sectors fall under that umbrella. And because the Nasdaq 100 is more weighted toward technology than the other broad-based indices, I like to keep a close eye on how is the index doing versus SPX or the Russell 2000, because I think it gives you an indication that stock investors who are looking forward, maybe looking forward to an economic recovery.
Yeah, and every time we get somewhat of an inkling that the Fed either might reverse action or dial back its rate hike strategy just a bit, you see the Nasdaq 100 greatly outperform the other major averages.
Absolutely. We had a dramatic and then a mini melt up back in November. I think it was November 10th. The index gained, gee whiz, like 7.5% in a day. And the other two indices, I think the S&P was up 5.5% and the Russell was up around 6%. And then we got another melt up just toward the end of the month where the Nasdaq was up, index was up, I think 4.5%, and greatly outperformed those two indices. And that's the kind of reaction that you get when the Fed says things that make you think that maybe a recession is going to be soft or it's not going to be very long at all. And you want to get into the sectors that perform as we start to recover. And again, technology totally falls under that umbrella.
Let's talk about the volatility indexes for a moment, VOLQ versus VIX. And VOLQ has been at a premium for most of 2022. Is that typical of the history?
That's not typical of the history. I think about 1 out of 3 days, if you take the VOLQ history going back to 2014, you would actually see VOLQ at a discount relative to VIX. I didn't have a chance to dig into the numbers as much as I wanted to, but I'm almost certain that it hasn't happened more than a handful of times in 2022, if at all. So this consistent higher risk level being priced in for the Nasdaq 100, it's what you would expect in a year like this when everybody's worried about the economy slowing and the Fed's not really doing things to soften the economy slowing. But as we've gotten toward the end of the year, the spread between those has started to narrow. And one of the things that I think will give us an early indication that we're looking at an economic recovery is when we consistently see VOLQ in line with VIX. Right now, it's like about a 4-point spread. I would expect those two probably in early 2023, if what I think is going to happen happens, where we see VOLQ starting to be at a discount relative to VIX every once in a while.
So then is there a strategy here?
Right now, strategy is keep a close eye. If you're worried about the overall economy and you're still on the sidelines stock-wise, watch for some consistent outperformance of the index. When we get those pieces of news that the bulls are hanging their hats on, we see NDX outperform, but then we might see after the big spike, we'll see a little bit of underperformance from day to day. I'd like to see a consistent couple of months of NDX outperforming the S&P 500 and the Russell 2000 before I jump back into stocks with both feet.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.